all I have done is I have taken and created one fib retracement from really the beginning of this rally. You can see that the market had just come in right at around almost $1,000, but then I think that was, in fact, was the first time that it was able to effectively close. But from there, it had this very, very large correction. And this long run here, in which the market moved from about 700 all the way up to its record high, which is over 1900, I think 1920. It's the single longest run in the history of gold. When we create a fib retracement for this, we get different levels. And the different levels are what we want to note. But again, I talked about 61 being important. And when we look at this simple fib retracement that was complete in terms of its time parameter, this is what, July of 2011? Yeah, July of 2011. These numbers right here, these lines were already hard pressed. They were in play. And they told us some information that in many instances will give us insight you just can't get anywhere else. Now, oddly enough, when we look at these recent lows that the market has hit, and this is the double bottom that has actually got me bullish, and we'll talk about the bear market truncation as we go into my outlook, but not exact by any means. You can see that it's slightly above this, but the fact that you can say to yourself that typically when a market moves from $1 to $2, when it corrects, even if it's on a bullish path, in other words, what I mean by that is that typically in a marketplace itself, it's going to be a stair step. So it's going to have a rise or a rally. It's going to correct a certain amount, then a rise and a rally, certain amount, like that. It stair steps up. And so what Fibonacci is able to discern is there's a natural sequence, a natural pattern in the way things occur that tell you that there's logical points to look for certain things to happen. Does that mean that the market's going to do that? Well, of course, absolutely not. But it gives us a little bit of insight in terms of being able to ascertain where the market might go. So this is basically a basic fib retracement. You can see that more than just the single number lines up, it gives us more information. So for example, our 38%, if we draw that right in here, you can absolutely see that as this market came down and tested the 61% and then comes up and rallies, it's quite interesting that it kind of falters right at this fib number. And I see many names I recognize of my subscribers. My subscribers know how much weight I put towards Fibonacci, because Fibonacci itself really attempts to outline a natural sequence or order, and technical analysis is simply looking at market sentiment and trying to quantify it mathematically. To me, this is a very, very insightful tool. And as I said, if you only get one thing out of it, it's to remember those numbers, 0.61 and 161. And by doing a simple fib retracement, and pretty much all of the software applications do have that, you're able to come up with some pretty interesting information in the marketplace itself. Now, from there, there's also something that's called a Fibonacci extension. And on an extension, it's really part and parcel of the same thing. Again, you're looking at certain numbers, and let's go ahead and kind of line that up. And really what I did in this particular study is I did what's simply called a fib extension. And I looked again, this is really the beginning of this large rally right here. And as you can see from this chart, you can see here's where it hits that 1,000 and then backs off. So if I look at the first real rally itself, take it from there to there, and then I do what's called an extension. 138% takes us pretty much to the top. 121% takes us pretty much here. There is some information that's available. And you can see then again, this top is at a 61% extension. And what's interesting is this 61% extension was a 61% retracement of the same move. In other words, what you'll begin to uncover with Fibonacci itself is that there's a fractal quality to it. There's a quality to this technique in which you are looking at things kind of like a Russian doll, where one fits into the other and into the other, but they're duplications of that same sequence. That's nature's building blocks itself. And so it's for that reason that we really look at this in such a high regard. So I now had Fibonacci, and I now looked at candlesticks, and really the way that I combined the two of them was, as I said, there's specific patterns that we look for in the marketplace itself. And so that as a market is trading, if it hits for example, a certain level within the market, in essence, what I'm looking to do is see if I can uncover some sort of a candlestick pattern. This is a variation off a Three River Morning, but it's really not that good. But as you get to this top, and you can see there's real resistance here, you get these series of dojis. This is that Three River Evening Star variation. In fact, I did an article for Kitco News maybe 2.5 years ago, where we actually looked at how many variations I saw as the market went up. And so it really is an important component to putting together a technical model. Now, there's a third kind of a wheel that I use with this model, and that is Elliott Wave. And Elliott Wave to me is kind of like poker, in that it will take you maybe a day or two to learn and a lifetime to understand. Secondly, it's an extremely subjective model, in that a moving average is a moving average, and a 61% retracement is a defined hardcore number. But in terms of doing what's called that wave count, that can be subjective, and you'll get a lot of Elliott Wave technicians coming out with a different count or different conclusions based upon their count. So in that way, the reliability goes way, way down, but Elliott Wave attempted to do something that was never done before, and that was the whole meaning of what I'm trying to talk about, the difference between a lagging indicator and a leading indicator. Now, I believe candlesticks to be one of the earliest, if not the earliest, leading indicator that is, because when you see a pattern, let's just go ahead and blow up a regular chart, but when you see a pattern such as this doji cluster, this is an engulfing bearish. You've got what's called a tri-star top here, and all of this is a variation off a Three River Evening Star. It's telling us that at this particular point right here, and I add the confirming candle because it's a very, very good filter, but at this particular point, it's telling us that the market is going to head lower. Now, you get an engulfing bullish. It doesn't confirm, as you can see on the next day. The following day it does, but here you get another engulfing bearish. So we've gotten two engulfing bearishes. We've gotten a cluster of dojis at the top, and that pretty much is telling us that what we can look for in the upcoming future is lower pricing. That, to me, ladies and gentlemen, is a leading indicator. However, what it's not telling us is the timeline involved and where these lows might take us to. And so when you combine candlesticks, Fibonacci, and Elliott Wave, and by the way, Fibonacci is ingrained in Elliott Wave and the Elliott Wave principle. And in fact, when R.N. Elliott first revealed and did his study on the wave count that he developed, he didn't realize the connection to this golden mean, this ratio, this Fibonacci sequence, until it was brought to his attention, and he realized that he was using this Fibonacci in terms of his work incredibly frequent. Now, third book that I'm going to recommend to you today, and it's the last book I'll recommend, it's enough for one day, but this is R.N. Elliott's Masterworks, and really what it is, it's a collection of all of his papers and his knowledge. It's a incredibly good book in terms of wanting to learn about Elliott Wave. This is where you want to get your start after you kind of comb through the internet. So in terms of what I recommend in every technical trader's library are these three books: Japanese charted charts, technical analysis of the financial markets, and then lastly, R.N. Elliott. So what have we been able to accomplish by actually putting these indicators together? Well, as I said, candlesticks gave us that mathematical view of market sentiment, and it would give us, most importantly, pivot points. Points to look for key reversals in the market. There are also patterns that are called continuation patterns, and they're telling you that the current direction of the market should continue. There are exhaustion patterns, but these patterns, when you are able to identify them and look at them fairly quickly, what you'll find is that when you start putting the three of these techniques together, it gives you some phenomenal insight into the marketplace itself, and it gives you insight, honestly, that you're just not going to get really anywhere else. Now, there's really a third thing that we added to this, and it's just very, very old school, but it's just basically trend analysis, channel lines and trend analysis. Now, we talked about the fact that when we did a basic fib retracement, and the retracement was started from here to this particular top, when we looked at the defined bottom, this bottom itself came to about a 61%, just a little bit above. Now, here's another way that we can accomplish kind of the same task, but it's Western old school, but it's an oldie but a goodie. It tends to give us a lot of information. If we peg these original lows here, this being 0.1, go ahead and get this up. And then we take, you got your rally, and then we go to our secondary low. Obviously what we do is we create an angle. And this angle from this low to this low gives us a tact. In other words, a defined way that this particular angle moves up and at what degree is it is, 90 degree, 45 degree. And when we do that, what you'll see is that these recent lows are really still above this long standing support line. It's the resistance line right now that interests me mostly, which is this resistance line right here. We'll talk about that in a second. But when you consider the fact that just by looking at the angle from here to here and drawing that up, as this market came under fire, there seems to be a logical reason that we could be in fact looking for a bottom. And it's pretty easy when you want to think about it in a certain way. Let's go ahead and put our fib back up here. So here, as you can see, just classic standard trend analysis combined with a fib retracement. And what you'll see is that there is a point in time in which you kind of get this intersection. And lo and behold, this intersection just happens to occur right at this most recent bottom. Now, to define the techniques themselves and really the way that I looked at it, I first published a paper, and this paper was called The New Technical Triad. And in essence, there are reprints available. You can email me at Gary at the Gold Forecast. We'll send you a link to that. But I defined the fact that when I actually started combining different techniques, I found that by putting together Elliott Wave, Fibonacci, and candlesticks, I was really able to get a pretty good grasp of the market, and more importantly, have a pretty unique way to look at the marketplace itself in a way that gave me insightful knowledge, but usable, tradable knowledge, not the fundamental knowledge that, as Bernanke speaks and people are reacting, I'm a dollar late and a dollar behind. It actually told me what I can look for. And from there, I realized that there was a way to combine these three techniques and to actually create models from them. And that, to me, was really one of my big aha moments. Now, this isn't complete. We've just started this, but I basically wanted to go back and look at the calls that I've made, the candlestick forecast was developed back in the, I would say 92 is when we had it copyrighted. But the gold forecast, which is a daily video newsletter in which we actually go, we give our market analysis and give definitive, concrete trade recommendations with stop placement and kind of walk all the way through. It's my part of fishing, not teaching people to fish. I wanted to see how it, I know that I was profitable year in and year out. And by the way, my first couple of trades this year have been losses. I don't want you to think that this is a very, very clear and easy road. It's not. But this is the track table as we put it together. This is available on our site. If you go to our site under under our services, you'll see this track record table. That's so anybody can get to it. And it's got 2010, 11, 12, 13. 14's just started, but I'm being honest with you up front. I've taken 3 hits actually, in the marketplace, but I've kept my losses small because I keep very, very tight stops in a market. But if we look at year one, if you had invested $10,000 when the market had, or the gold forecast had first come out, by the end of that year, you would have made about $30,000, and so your $10,000 investment now was about $40,000. You can also see that we have these little players. So what I've done is we've created a way so that you could go in and take a look at the individual videos where I made those recommendations and see what I was thinking at that time. So as I said, this is really our first year, 2010. In 2011, we were able to squeak another $32,000. This is with that same original $10,000 investment. You're up to 72. 2012, that was a fairly tough year. 22, now we're up to 95. And then last year, we've just got done compiling them. Very, very difficult year, especially if you're a gold bull like I am, to be able to profit. I mean, you had gold down, 28, 30%. We actually made about 140% on the year. I look at it as dividing 10,000 into the amount. And so an original investment of $10,000 back at the beginning of when we came out with this, if you had taken every trade, could have been, a return of about 100,000. The reason I tell you that is that there is strength in this technique. There's absolutely, and realize there's incredible risk. The risk will most definitely be substantial, and losses can be occurred and in fact do get occurred. So I just want you to understand that in terms of using any kind of a system itself. But when we put it all together, and that's what I want to do, because I really wanted you to get a sense for what we did, how we did it, and now with that in mind and some of the past results, I can give you an idea of what I'm looking at and where my current take on the market is. And to do that, again, I'm going to pull up a weekly chart. And on this weekly chart, let me kind of move these lows in here. And I'll tell you, one of the reasons that I really, really love working with eSignal, their charting platform is exquisite. There's 2 of them that I use. This is one, and there's one other that I use. But the dynamics of their platform is incredible. I started working with eSignal when they were Data Broadcast Company, DBC, and this is back in 1993 or 94. I've always loved their data. Their data's clean. And an old programming saying is garbage in, garbage out. Without clean data, I can't do my job. And really what we're looking at here is a basic count of what we saw. And what I mean to say by that is as follows. The market will typically move up in a stair-step pattern. And the belief is that is a series of waves. So you might have something like 1, 2, 3, 4, and then you'll get wave 5. Now within this 1, 2, 3, 4, 5, in other words, this entire group is simply called your impulse phase. Let me get another drawing tool up. This is what's known as your impulse phase, a series of 5 waves, 1, 2, 3, 4, 5, and from there you will typically get what's called a corrective pattern, and a corrective pattern is typically what's called an A, B, C. So we're in this incredible bullish run. The market is moving up. It hits this record top. I thought it was going higher. I was wrong. Many people were wrong, but we started to get some signals. And so we got this ABC, which is basically what's called a flat here. Your A and your C are about the same. And my sense was at this point, we were going to witness this market take off and go to new record tops, because I thought that what we witnessed, 1, 2, 3, 4, 5, ABC, completes the entire cycle of 8 waves. And what will happen is, as long as the sentiment that it was available when this market went up is still in the market, this cycle will simply repeat itself. So I was looking for the market to do as follows: 1, 2, 3, 4, and 5, and go to new highs. Well, nothing could have been further from the truth. It absolutely wasn't the way this market played out. And as we look at it in hindsight, the first clue we really got that something was amiss was right here, because for our current Elliott wave model to work, if we went back into a bullish impulse phase right in here, we had to break above this particular top, but we didn't. And that's where we actually started our bear count. The fact that the market couldn't make it through here, we had this double top, rather than this being a what's called a bull count 1 through 5, we got a bear count 1 through 5. And a bear count is simply the opposite of our bull count, in which we got waves 1, wave 2, wave 3, wave 4, and then wave 5. We'll talk about this part because that's really where the outlook comes from. And in the same way that, as I said, we looked at a scenario like this, 1, 2, 3, 4, 5. At this top, we looked for what's called the counter trend. And the counter trend is what's called your corrective period, basically made up of an ABC. So you go 1, 2, 3, 4, 5, and then, let's move this over a little bit. And then from there, of course, you get an ABC correction. Now, the difference is you've got your long wave 3, your 4, then you'll go into your 5, and typically, 5th wave is going to be below wave 3. So in a standard marketplace itself, you'll get a lower low. However, when we hit this double bottom, it brought up the idea that what we could be witnessing was simply called a bear market truncation. And what I want to do for you is I put together a little video of a bear market truncation, but realize that I put this video together back in the end of November, beginning of December. It's only about 3 minutes. From there, we will absolutely give you our outlook for 2014. And the pattern that I kind of want to discuss with you is simply, it's a bear count, but it's a bear market truncation. And this comes directly from some work by Frost and Prechter off of the Elliott wave principle. And it is a truncated 5th wave. And in essence, what you're looking at is this. Typically on a bear count, what you're looking at is 1, 2, long 3rd wave, 4, and your 5th wave will typically be what's called a standard zigzag, in which the low of 3 is going to be above the low of 5. Now, when you have equal lows, we've talked about this many times, it's simply called a flat or a truncated 5th wave. Now, why am I presenting this to you at this point? Let me show you. I've simply pulled up our 2-day chart that has our current Elliott wave count, this being the top of 2 here, which of course is going to match this 2 right in here, will match to this 2 right in here. And from there, of course, we have our long wave 3 here. This is our long wave 3 here, and this is what forms that low. This is the key to looking at this pattern. Now, from this, we get our ABC, or we get our 4th wave up, just as we get here. And I have been talking about the fact that wave 1 and wave 3, and I'm talking about this wave 1 here and this wave 3, should at least be equal, and that's what has plotted our lows to at least match these lows at around 1181. However, we've actually come fairly close, and with this recent low of 1211, we're just $30 off of this low. So what this particular bear market truncation pattern would look like if in fact it would unfold. And as I said, traders, I'm not giving this an incredible, a high probability of unfolding this way, but it is nonetheless something that we can look at. We have come actually fairly close now to the lows. So we've gotten our matching lows down here, and then with those matching lows, of course, we would then get a spike to the upside here to end this 1, 2, 3, 4, 5, and we would in essence go into an ABC, which is the counter trend, but that would certainly be signaling higher prices in gold if in fact the market held in this area. So as you can see, I've removed the candlesticks, everything to identify and focus only in on a wave count. In essence, what we would look at if it was to unfold something like this is we had 2, 3, we have 4. This is the truncated fifth, and then you would move back up. Now, how can we determine if in fact that's what we're looking at? Well, a couple of things have to happen. The first thing is the market would have to trade over 1255, 1260, where we have our stops. There's a triple top there. Until that's taken out, we've got to remain bearish. One. Secondly, most necessary would be we've got this really long-standing trend line, this resistance line, and this resistance line has been incredible in terms of pointing out these last two recent tops in the market, because we had the failure to really kick above that point and see the market kind of genuinely, as it was trading up, break through this or to break through the resistance here. Because it wasn't able to, we've identified this really, really strong resistance line. We'd have to break through that also. Now, of course, as this market moves down, so does this slope. So where that would intersect would be something we could talk about on another show. But nonetheless, we have actually gotten fairly close to having what's called basically a flat. And a flat is one in which you have waves 3 and 5 really have the same low. It's also known as a bear market truncation, and I thought it was close enough that we can at least watch to see if it unfolds in this way. As I said, we would have a long way to go before I would get bullish, but if in fact the market were to get bullish, these are the things that we would see at this point. But as I said, we would need some confirming technical evidence, of which we haven't gotten any yet, but nonetheless, the fact that we're now near these lows at least warrants us considering that as a possibility, a model in which the market could unfold. It's worth our thought anyways. Alrighty, as I said, that was something that I put out back in December. Now, I did get a question, and I want to address this immediately, and this is by Bruno, that the Elliott wave, what he's speaking about, and I have to make sure that if you're referring to the 1 through 5 count on that long uptrend, I was just putting in the fact that it's 1 through 5. If 4 goes into 2, it's absolutely invalid. Let me go pull that up again. All right. There's no question about the fact that there is 3 golden rules in Elliott wave. And the first of those is that wave 3 cannot be the shortest, wave 2 cannot exceed wave 1, and wave 4 cannot overlap wave 2. And what they mean by that, I've got to change the color of this. What they're referring to is you've got this one wave up, and you have your corrective wave. This is wave 2 in a bull count. Market moves up, and then you get a corrective wave in wave, this is your wave 4. So 1, 2, 3, 4, 5, 2 and 4 are your corrective. Your impulse is 1, 3, and 5. This low right here cannot go into the territory of this high. And that's what Bruno was mentioning, the fact that these two cannot intersect. And so that I just want to make sure that if what Bruno was talking about was my basic count as I went up, I could have easily mislabeled the count. In terms of this coming down, though, and this is the count we're using, Bruno, and that's why I want to clarify. Wave 1, this is wave 2. This is the bottom of wave 2. Wave 4 cannot come into this zone right here. And that, I believe, is what Bruno's trying to mention. Bruno, did I answer your question? Because that's important to me. I don't want to give out the wrong information. Wave 4 cannot overlap wave 2, and you don't see it overlapping. This is wave 4 right here. This is wave 2. There's zero overlap. Okay? And that should hopefully answer the question. Okay? Now, in terms of where we are and where I think we're going, and then if you can hold your questions till the end, I'll try to leave some time for that. I realize I'm running on a little bit longer than I'd hoped to, but I tried to cover a whole lot of material here today. But in essence, what I'm looking at is this. We had this long wave 3 down. You have your corrective wave 4, and 4 does not overlap into wave 2. This is our wave 2 right here. There is no overlap. We go to wave 3, and as I said, typically wave 3 and wave 5, you're going to have a lower low on wave 5. When we hit this particular bottom, this double bottom here, it gave me a sense that we at least want to look at the idea that what we're witnessing is a bear market truncation. Now, the second thing that I found to be very revealing and insightful was, if you look at these series of tops, you had a triple top here at 1800. That was the last time right here that the market actually hit 1800. When this market had this tremendous fall from grace here, this tremendous move down, and hit this particular bottom, when we saw this matching bottom come up and it start to spike off of that, we could be looking at two different scenarios. One is that this wave 5 hasn't completed, so you're getting 1, 2, 3, 4, and that would state you're getting a fifth wave down to complete it, and it's not a bear market truncation. And as I said in that video, what we really want to look at is what technical evidence are we going to need to ascertain that it is breaking out of that. And I'm going to try and draw this as straight as I can. When we look at this long-standing resistance line, and this resistance line was created from when the market fell, let me get a color I can use, by looking at these particular tops here and then carrying that angle lower, what it told us was that we had one real rally in 2013. Market comes down, hits 1181, and then moves up to 1435. Now, 1435 is really the upper level of this resistance line. It doesn't break through, and in fact then begins to trade lower. You get another smaller rally, and once again, it comes to this line, doesn't break through, moves back down. Now, on this last rally, at least for the time being, and this is why we're in this nebulous area, I do a show called Chart This for Kitco News. It comes out 2-3 times a month. And I said that we had absolutely broken above this long-standing resistance line. Lo and behold, the next week it kind of went back to that line. That's this red candle here. In fact, let's blow this up a little bit. And we'll put back our resistance line. We clearly saw that really for the first time, and almost any way you want to look at it. Now, as I said, that is, of course, one distinct possibility. Of course, my sense